This is Kenny Tam. Welcome to Real Estate License in 14 Weeks. This is episode 22 of Starting from Zero. We continue to talk about chapter 6. If you like my video, please give me a thumbs up, subscribe to my channel, hit the bell, and then share it with your friends. Construction financing. What is construction financing? I'll give you a scenario, an example. If you have a piece of vacant land, you want to build your own custom home on that vacant land. Well, usually it's hard to get a loan on a vacant land because there's no structure on the land. So what you can do is you're going to get a construction financing. In order to get construction financing, usually it requires a high equity, which means that usually when people buy a piece of vacant land, let's say for example, the land itself costs $1 million. The maximum that you can get on a construction loan is usually 60% of the appraised value of the land, which means that the maximum usually you can borrow against the land is about $600,000, assuming the land is worth about $1 million. Why construction financing is actually what we call a short-term loan. Why is a construction financing a short-term loan? The reason is the interest rate is usually higher than a long-term loan. Now, construction loan is also known as an interim loan. Interim means temporary or short-term. And usually after the construction is completed, you will do what we call a takeout loan. What is a takeout loan? A takeout loan is a permanent loan that is taken out against the property after the construction has been completed. Now, normally on a construction loan, the lender will not make the last payment to the contractor until the period for the mechanic liens has expired. As we know from the previous chapter, the contractor has a certain amount of time after the project is completed to record a mechanic's lien. So obviously, to protect itself, the lender has to wait until the period to record the mechanic's lien has expired. We're going to talk about the three different types of loans. Number one, we're going to talk about FHA loan. Number two, we're going to talk about VA loan. Number three, we're going to talk about Calvet loan. Let's start with FHA loan. FHA stands for Federal Housing Authority. As previously mentioned, FHA loan has one of the attractive things about FHA loan is the low down payment. The lowest down payment you can get for FHA is 3.5%. And then for the qualification, anybody who meets the credit standards for FHA loan can apply for the loan, can qualify for the loan. And assumability. FHA loan is the type of loan that you can assume. What does assumption mean? It means that a buyer can essentially take over the loan and then the seller can be released from the loan. So the loan stays with the property. And then we're going to talk about prepayment penalty. No prepayment penalty is allowed for FHA loan. As far as security instrument is concerned, the security instrument is the trust deed. So basically, when you apply for an FHA loans are not made by FHA. FHA loans, contrary to many people's belief, are made by lenders. What FHA does is just to insure the loan. They don't make the loan, but the lender makes the loan. So in case of a borrower default, the lender can go to the government, the FHA, to reimburse them for the loss. That's why FHA insures the loan. FHA doesn't make the loan. The second type of loan we want to talk about is the VA loan. Who administers a VA loan? Now, VA loan is administered by the Department of Veteran Affairs, the DVA. One of the unique things about VA loan is that it does not require any down payment. As long as the borrower can qualify, no down payment is required. A VA loan is also assumable, but only by another VA, by another veteran. and no prepayment penalty is allowed. And just as the FHA loan and the VA loan, there is a certain loan limit. For exam purposes, you will not be asked to remember what the loan limits are, but just so you know, FHA and VA loan, they both have loan limits. And VA loan does not allow prepayment penalty. The security instrument for VA loan is the same thing as a FHA loan, is trust deed. So if you get a VA loan, and a VA loan is normally made by a bank. When bank makes you a VA loan, the VA loan is insured by the DVA. In order to figure out how much money you can borrow for a property for a VA loan, they have to do an appraisal, and you get a certificate of reasonable value. Certificate of reasonable value is basically an appraisal report performed by an appraiser who's familiar with the VA's procedure for appraisal. Lastly, the next type of loan is what we call the Calvet Loan. Now, the Calvet Loan, it is administered by the Department of Veteran Affairs, but it is a state-funded loan. Now, it is a loan that is also assumable, but is subject to credit requirements. So just as in the case of FHA, a Calvet loan requires that the borrower would have to be pre-qualified. So if a buyer comes along and want to buy a property from a seller who has a Calvet loan, and that buyer can actually assume the Calvet loan provided the buyer meets the credit requirements. Just as the FHA and VA loan, a Calvet loan actually does not allow prepayment penalty. The unique thing, what makes Calvet loan different from FHA and VA loan, is that the security instrument is not a trust deed. The security instrument is a real property sales contract. As you remember in the previous chapter, you know what a real property sales contract is. It's the type of security, it's a type of deal where the buyer really does not get title to the property until the buyer has paid the seller in full. Now in this case, when you have a Calvet loan, who is the entity? Who is the seller? The seller is actually the state of California. So the state of California actually holds title to the property. The state of California goes out and purchase a lot of properties and then sell it to a veteran. Now in the process, they will get a real property sales contract, and that might be in the exam. So remember, FHA and VA trust deeds as a security instrument, and then for Calvet loan, real property sales contract is the security instrument. One other thing I want to add about Calvet loan is that Calvet loan requires the veteran to carry insurance, life and disability insurance. Well, why does Calvet loan require the borrower to carry life and disability insurance? Because it is not secured by a trust deed. It is secured by a real property sales contract. So what that means is the government is concerned that if the borrower becomes disabled, there is nobody to make the payment for the borrower. So that's why in order to get a Calvet loan, the government requires the borrower to get disability insurance and also life insurance. This is the end of episode 22. See you next time.